Today our subject is partnership. We shall solve several problems of partnership, but before that we must know the fundamentals of partnership accounts, because if we do not know the rules properly, we cannot solve the problems. So please be patient and understand the basic rules to solve the problems of partnership accounts. Hello everyone, welcome back to the Science of Accountancy. So first, what is partnership? Partnership is a cooperative relationship between two or more individuals, organizations or entities who have agreed to share profits and losses of a business carried on by all or any of them acting for all. The persons, organizations or entities who have entered into partnership are individually called partners and collectively a partnership firm. From the accounting point of view, partnership firm has a separate entity, means the partners and the firm are not the same, they are separate. We should keep it in our mind during accounting of partnership. But from legal point of view, it is not a separate legal entity from its partners. Now the features. To form a partnership, we need minimum 2 persons and maximum 50 persons. Though the Partnership Act 1932 does not prescribe the maximum number of partners, it is prescribed in the Companies Act 2013 to be 50. There must be an agreement. It may be written or verbal. The intention must be to do business, obviously. Liability of a partner is unlimited, as from legal point of view the partnership firm does not have separate legal entity. Profit and losses must be shared among the partners. Well, now the partnership deed. Partnership deed is a written agreement between the partners. As I have told earlier, partnership requires an agreement. According to Indian Partnership Act 1932, it is not mandatory to have a partnership deed in writing, but to avoid the dispute in future, it is better to have a written agreement. A partnership deed contains the following: description of the partners, description of the firm, nature of business, capital contributions, interest on capital, interest on drawings, partners' remuneration or commission, interest on loan, valuation of goodwill, etc. And obviously, profit sharing ratio. Now we shall discuss what should we do if the partnership firm does not have partnership deed, or if the deed is silent in respect of the following matters. The provisions are as per the Partnership Act 1932. Sharing of profit or loss. If there is no partnership deed or the deed is silent about this matter, profit or loss will be shared equally. Interest on drawings. No interest will be charged on drawings. Interest on capital. No interest will be allowed on capital. Interest on loan by partner at the rate 6% per annum, even there is a loss. Interest on loan to partner. No interest will be charged. Partner's remuneration. Remuneration will not be allowed to partner. Now let's discuss about Profit and Loss Appropriation Account. We have learnt about Profit and Loss Account earlier. Now, during accounting for partnership, we need to prepare a new account which is called Profit and Loss Appropriation Account in addition to Profit and Loss Account. It is basically an extension of the profit and loss account. After closing profit and loss account, we need to transfer the net profit to profit and loss appropriation account. By profit and loss account, we determine the net profit, and by profit and loss appropriation account, we distribute the profit among the partners. The accounts which are posted into profit and loss appropriation account are called appropriation of profit. Example, interest on capital, partners' remuneration, etc. In simple words, the transactions which are paid or payable to the partners or received or receivable from the partners will be posted into profit and loss appropriation account. Now let's learn about charge against profit and appropriation of profit. Charge against profit is expenses deducted out of revenue to determine net profit or net loss. And appropriation of profit is distribution of profit among the partners as per partnership deed. Now the difference between both. Charge against profit, it is debited to profit and loss account. Appropriation of profit, it is debited to profit and loss appropriation account. Charge against profit, whether there is profit or loss, expenses that are charged against profit are accounted. In case of appropriation of profit, appropriation is made when there is a profit. Again, for charge against profit, examples are interest on loan by partner, rent paid to partner, etc. And appropriation of profit, examples are interest on capital, commission to partner, etc. Now take a look into the journal entries for profit and loss appropriation account. For transfer of net profit from profit and loss account to profit and loss appropriation account, journal will be profit and loss account debit to profit and loss appropriation account. For interest on drawings, there will be two entries, one for adjustment, that is for the transaction, and another for closing, that is to transfer the amount into profit and loss appropriation account. So adjustment entry will be partners capital or current account debit to interest on drawings account, and closing entry will be interest on drawings account debit to profit and loss appropriation account. Now for interest on capital, adjustment entry will be interest on capital account debit to partners capital or current account. Closing entry will be profit and loss appropriation account debit to interest on capital account. For partners remuneration, commission or salary, adjustment entry will be partners salary or commission account debit to partners capital or current account. Closing entry will be profit and loss appropriation account debit to partners salary or commission account. Here we have used capital or current account. What is current account? We shall discuss later. For transfer to reserve, journal will be profit and loss appropriation account debit to reserve account. At last, for distribution of profit, journal will be profit and loss appropriation account debit to partners capital or current account. Now let's do the accounting. We shall solve a practical problem. Here is our illustration. Remember, for every solution, you need to read and understand the problem carefully. Ram and Rahim start business on 1st April 2023 with capitals of Rs 2 lakh and 1 lakh respectively. sharing profits and losses in the ratio of 2:1. As per partnership deed, interest on capital is to be allowed at the rate 10% per annum, and Rahim is to get a salary of rupees 4,000 per month. The firm earned net profit of rupees 3 lakh in the financial year 2023-24. Pass journal entries for appropriation of profit and prepare profit and loss appropriation account for the year ended 31st March 2024. Thus, here our duty is to pass the journal entries and to prepare the profit and loss appropriation account. Let's start. First, we shall draw the format of the journal. Here it is. Now see, profit and loss appropriation account is prepared after the closing of profit and loss account. Hence, we shall start from the transfer entry of the net profit into profit and loss appropriation account. Here the net profit is 3 lakh, which will be transferred into profit and loss appropriation account. Journal will be, as we have shown before, profit and loss account debit to profit and loss appropriation account, rupees 3 lakh. Now Rahim, one of the partners, has been given a salary of rupees 4,000 per month, that is rupees 48,000 for the year. Journal will be, remember there will be two entries, one for the adjustment and the other for closing. Hence the first entry will be partner's salary account debit to Rahim's capital account, rupees 48,000. It is the adjustment entry. The next entry will be profit and loss appropriation account debit to partner's salary account, rupees 48,000. It is the closing entry. Now interest on capital. First entry will be interest on capital account debit, rupees 30,000, to Ram's capital account, rupees 20,000, to Rahim's capital account, rupees 10,000. The calculation is too easy. Interest on capital is 10% per annum. Ram's capital is 2 lakh, hence 10% of 2 lakh is 20,000, and Rahim's capital is 1 lakh, 10% of 1 lakh is 10,000. It is the adjustment entry. The second entry for this transaction will be profit and loss appropriation account debit, rupees 30,000, to interest on capital account, rupees 30,000. It is the closing entry. There is no other transaction in this illustration. Hence, we shall pass the entry for profit distribution now. Journal will be profit and loss appropriation account debit to Ram's capital to Rahim's capital. Now you are thinking about the calculation. Well, we shall see the calculation during profit and loss appropriation. We have done all the journal entries required for this illustration. If you have any doubt, you can comment. The next step of the illustration, we shall prepare the profit and loss appropriation account. Here is the format. Now, do you know the rule for ledger posting? We need to do exactly the same. If you have doubt on ledger posting, please refer to our separate video on the same, link in the description. However, our first entry was profit and loss account debit to profit and loss appropriation account, rupees 3 lakh. As per the rule of the ledger posting, profit and loss account will be posted into profit and loss appropriation account at the credit side. Second entry was partner's salary account debit to Rahim's capital account. There is no sign of profit and loss appropriation account in this entry, so it will not be posted into profit and loss appropriation account. Third one was profit and loss appropriation account debit to partner's salary account. Here partner's salary will be posted into profit and loss appropriation account at debit side, rupees 48,000. Again, the fourth entry was interest on capital account debit to Ram's capital to Rahim's capital. You know, it will also not come into profit and loss appropriation account. Fifth entry was profit and loss appropriation account debit to interest on capital account. Hence, interest on capital account will be posted into profit and loss appropriation account at debit side. But here it will be posted showing the individual share of the partners. That is Ram rupees 20,000 and Rahim rupees 10,000. Now the final part, entry for the distribution of profit. Profit and loss appropriation account debit to Ram's capital account to Rahim's capital account. Here, partners' capital will be posted into profit and loss appropriation account at debit side, but showing individual share of the partners. Fine. Here is the calculation of the share of profit. Total of the credit side of the profit and loss appropriation account is rupees 3 lakh. And total of the debit side is rupees 78,000. We can see that the total of the credit side is greater than the total of the debit side. Hence, we shall write the total amount of the credit side as total of both the sides. Now the difference between debit and credit is the divisible profit, rupees 2,22,000, which will be distributed between Ram and Rahim. Here the profit sharing ratio is 2:1 and the formula is divisible profit into partner's share of ratio divided by summation of share of ratio. Thus, Ram's share will be rupees 2,22,000, that is divisible profit, into 2 Ram's share divided by 3, that is 2 plus 1, the total of the profit sharing ratio, equals to rupees 1,48,000. Similarly, Rahim's share will be 2,22,000 into 1 by 3, that is rupees 74,000. Thus, profit and loss account will be closed. I hope it is clear now. We shall come with some other videos on partnership with the remaining part. Please subscribe the channel and click on the like and bell button to encourage us.